Precious metals, of course, one beneficiary of the weakening greenback has been gold, posting its biggest week of gains since January. That was last week, following, of course, some disappointing US economic data. Big question then for us this morning, does gold have more room to run? Joining us now is Commodities Analyst of HSBC Securities in the US, James Steele. James, great name for a Commodities Analyst, I've got to say, I'm sure you've heard that a couple of times before. I'll take it back to 2011, 2012. Greece was on the brink, as it is now. Monetary policy was on steroids, much as it is now. But every time I used to turn the TV on was this cash for gold advert, and it told me a lot about where the gold price was. You used to go there, give up your gold, and they'd give you a pathetic amount of money back. I turn on the TV now, no cash for gold adverts. Greece, yes. Monetary policy, yes. But the narrative, the inflation narrative, has changed radically. Is that the key driver for gold still? Well,
I think so. And also the uncertainty index is back down. If you look at the economic policy uncertainty index, it's actually back to where it was in early 2007, just on the brink of the crisis. Gold is still $600 higher than it was back then, so it hasn't given up all of its gains that it experienced through the crisis, but a good portion of them.
The sensitivity to US economic data, I get the one argument that you get some ugly data out of the US, and the narrative, the story that rates stay low for longer, that's endorsed by that weakening data. But then at the same time, that weak data, if that's recessionary or a weaker economy, then surely that is deflationary and a negative for gold. Which one is it when I look at that data out of the US?
Well, I think that's why the upside, we have a relatively limited upside for gold, primarily because of that. You do get a positive through the opportunity cost. I mean, very low interest rates. Low inflation don't give you much. Give you a relatively good opportunity cost if you want to buy gold, but to get a really strong rally going over many years, you would need somewhat higher inflation, which is why our upside is relatively modest.
When I look at the median forecast on the Bloomberg terminal, CPFC Go is the function if you want to know. I'm looking at a median forecast of Q4 year end 12.20. It's pretty much where we are now. Is that in line with what you think as well?
Well, we're looking for a little bit higher. Our average for the year is $1,234, but that's an average, so we're looking for it to be closer to $1,300 towards the end of the year.
James, from a portfolio perspective, and I know this is why you have to talk to clients quite a bit, it's what can this do for my portfolio? I've got a fixed income portfolio investment on the one side of it, and I'm yielding virtually nothing, and I'm very afraid about what inflation will do that. We've seen in the last couple of months what can happen to those investments, and I want to hedge. Is gold the best way to do that? It used to be thought that way. Is it still the best way to do that?
Well, you know, nobody's saying you should keep a very large portion of your portfolio in gold. But there was a good study by Levin and Wright, two economists in universities of Glasgow and Strathclyde, I believe, and they pointed out that during a crisis, a full-blown crisis especially, gold is one of the best things you could possibly have because it's inversely correlated to paper instruments. But if you buy it during a crisis, you'll generally be too late. So you've really got to hold it in abeyance in the hope that, well, in case a crisis were to occur.
When we're talking about a crisis, we're talking about the end of the world kind of Eurozone breakup scenario, one we're not experiencing right now, but one that we kind of experienced back in 2011, 2012. Is that what you would call a crisis?
Yes, that's right, and that's where you see the real potential of gold come in. Now, there's no predicting when this will happen, so that's why, you know, one would probably want to have a small amount of their portfolio in gold in case it were to.
The dollar story, just very briefly, we've touched on it. Am I essentially just trading the dollar in the short term when I'm trading gold?
That's probably the single biggest impact on gold, both short and long term, is the dollar. Gold is always inversely correlated with whatever the reserve currency is, and tends to be most correlated with the second reserve currency, which at the moment is the euro. It was the Deutschmark in the 80s, the yen in the 90s.
Big conviction trade for 2015, if I put you on the spot, gold or silver?
Silver possibly, well, they're going to be about the same. I think there might be a little bit more pent-up demand in the silver if we get good electronic and coin demand. You get down near $15 and the coin demand tends to pick up, and silver is very widely used across industry.
How is the coin demand outside of China, India?
It did fall off a little bit earlier this year, but we think it got down to levels where it's likely to be stimulated more for silver than for gold, I think.
James Steele.